Shein IPO looms amid global tax reforms, investor caution, by Satori News. As the European Union and other economic powerhouses move to tighten tax legislation surrounding imports, global investors are closely watching the implications for Shein, the fast fashion titan. Poised for a potential blockbuster initial public offering IPO in London, the retailer, recognized for its budget friendly clothing line, confronts challenges that could recalibrate its market valuation and future profitability. Shein made headlines with a confidential early filing for an IPO in June, eyeing a stellar valuation of $66 billion, echoing its fundraising achievement in the previous year. The company stands at a crossroads as legislators globally consider ending customs duty exemptions for low value packages, a pivotal aspect of Shein's competitive strategy by offering attractively low prices. The EU, for instance, contemplates eradicating the duty-free benchmark currently set for parcels valued under €150, with robust discussions of a customs reform introduced in May 2023. For clothing items like sports trainers and t-shirts, crossing this threshold would impose significant import duties. Adil Shah of Delphi Funds expresses the shared concern among sector investors, highlighting the culmination of this regulatory uncertainty as a paramount factor in the upcoming IPO. The investment community awaits further clarity on how Shein will navigate this potentially altered landscape, which could force a strategy shift. For its part, Shein emphasizes that its competitive edge stems more from its agile, on-demand business model rather than tax perks. The firm prides itself on a rapid response approach to fashion trends, leveraging an extensive network of China-based suppliers capable of adjusting production volumes in real time. This methodology is designed to constrain overstock and reduce waste. Despite Shein's confidence, Brazil recently applied a 20% tax on smaller international purchases, and the South African Revenue Service has its eyes on a significant duty increase for imported clothing parcels below R500, including the compounding effect of. In markets like the US and Britain, debate lingers among retailers and policymakers about comparable tax breaks, adding to a milieu of global fiscal reevaluation. John Hudson of Premier Miton points out the bind facing Shein: maintain prices and risk squeezing their slim profit margins, or escalate costs to the consumer and potentially lose competitive ground. These hard choices signal the direct connection between company valuations and the forecasts for their continuing growth and earnings. While Shein remains tight-lipped about financial figures, Bernstein analysts note a soaring net profit in the past year, indicating a significant uptake in profitability. However, this growth narrative could face a stark reevaluation if tax advantage initiatives are indeed curtailed. As such, the fast fashion juggernaut finds itself in a precarious position as it prepares for market entry, with investors and market analysts alike recalibrating their expectations for the business amidst evolving tax landscapes and consequent strategic shifts. Thank you for choosing Satori News.